Corporate finance practice problem using Excel. Cost of debt after tax problem 2. Get ready, it's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. We're going to have the information on the left-hand side, populating that information into the blue area on the right-hand side. We're taking into consideration the financing of an organization. You want to keep in the back of your mind financing through debt, financing through equity, and now we're concentrating in here on the financing of debt, which typically will cost in terms of the rent on the money, on the financing, like interest that would be cost for it. But we have the tax benefit related to that cost as well. So then we want to figure out, well, what's really the cost of the debt if it's going to have a benefit for this tax benefit, the taxes often complicating the situation. Now we can calculate this in basically theory on a percentage basis, and then it's useful then to think about the actual debt that you might want to finance and then think about it in that way as well. We'll work a couple different problems just so we can get this in our mind. So let's say that the company could basically finance debt at 12%. So it cost them 12% to finance it. The tax rate is going to be 26%. Remember that we do have a progressive tax rate, so you might be thinking, is that the average tax rate? What is that? But normally, again, if you're doing your decision on the margin, then you might be looking at the final tax rate, the end tax rate, rather than the average tax rate, because that's the tax rate that would be affected in your last decision, possibly. But taxes can be a little bit more nuanced than that if you think it's going to have an impact on multiple brackets. So you got to keep that in mind as well. We're going to take the 26% here. So let's calculate basically the cost of debt after tax. This will be basically the percent kind of calculation that we will get to, which you would think the cost being the rent percent, 12%, but no, tax benefit 26 here. So what then would be like the cost in terms of a percent? So we're going to say then we have the interest rate. Let's pick up the interest rate. Outer column, that's going to be equal to the 12%. So let's pick that up. That then numbers group, percentifying that. Then we're going to take the subtotal, which is going to be 1 minus the tax rate. And I'm going to make a colon and make a little subcalculation, which will be 1. And then we'll pick up the tax rate, which is going to be that cell, 26%. 26% on the tax rate. So I'm going to make that a percent, go to the font group, underline it. So then we're taking 1 minus the tax rate. So we're taking 1 minus the tax rate. And we're going to go to the numbers group, make that a percent. And this is going to be a subtotal. Going to do some highlighting these cells, alignment, indent, making it look nice, alignment, indent, make an underline here, font and underline. Then we're going to be taking the 12 times the 74, making that a percent, numbers group, percentifying it, and adding a couple decimals. We're at the 8.88 about. Again, a little difficult to understand this intuitively without basically having the debt calculation in there. You can memorize this formula and probably should, but you also kind of want to understand it intuitively here. So, right, the interest rate is going to be then the cost. That would be the cost. However, we get the tax benefit. We're taking 1 or 100% minus the 26%. That leaves us the amount that we're not basically going to get back with regards to taxes. So when we pay the 12%, in other words, we're going to get a benefit of part of it. That's going to be the tax rate at the 26. We're assuming 1 minus the 26 gives us the amount that we're not basically going to get a benefit on the tax side from. So if we take the 12% of times that 74%, that's going to give us our rate of the 8.88%. So although the cost of debt, the interest we're going to have to actually pay 12%, the amount of the actual after-tax cost, we're thinking it's going to be the 8.88. So we're going to call that the cost of debt after tax, and you might want to just put percent. I would call that kind of like the percent. Now, it's useful to recalculate this with an example. So if you were to kind of mull this over yourself, most people, I think, would come up with an example, give a debt example here, which would probably be more likely to happen in real life where we're trying to finance a particular amount, and then figure it out something like this, where you'd say, all right, well, the interest, I know if I had debt that I was taking out would be the 100,000 that I'd have to be, that's how much money I want. And the cost of that typically would be the rent, the interest on it, and I know that's what I'm going to have to pay. So I'm going to assume it's 12% that we have to pay. That's the rent on the purchasing power. So normally, if taxes weren't messing everything up, it would just simply be the interest would then be the 100,000 times 12, and that would not be a problem. But then we have the taxes that mess everything up. So let's go to the alignment, indent this, and indent this. So then I'm going to say, now what's the tax benefit? So the tax benefit would then look something like this. We'd have the interest, which now would be the interest expense or deduction. So I might even call it that. Let's call it interest expense deduction now that we have is going to be that 12,000 that we got. So from taxes, that's good for taxes. It's bad, but like for taxes, it's good because taxes are weird. So the tax rate, we're going to get a benefit of 26% on the tax rate because it's deductible. And so we're going to go to the numbers group, percentify that, font group, underline, and then that's going to be the tax benefit. So let's say tax benefit and multiply that out. So that's going to be the 12,000 times the 26%. So let's do some indentations here. Go into the alignment, indent that one, and then indent that one. So then let's underline this one. Go into the font group and underline. So underline that. And then we're going to say that we have the cost of debt after taxes would then be the rent of the 12,000 minus that 3,120. So the real cost to us in terms of dollars with this example would be 8,880. Now, if I want to think about that in a percent type of format, we can then say, okay, well, what's the cost of debt after tax percent then, colon, and we then go, all right, well, that's going to start off with the tax benefit. Let's just take the tax benefit of that 8,880 and compare that to divide the 1,000 cost of the debt. And then that's going to give us our cost of debt after tax percent. Like so. Percent. Like so. And let's indent this. Alignment, indent. And then indent this one again. This should be a capital C. And then we're going to say this is going to be the 8,880 divided by the 100,000. Percentifying that. Numbers group, percentify, underline. Font group and underline, adding a couple decimals here. So we'll decimalize this, adding a couple decimals. Let's give it a double underline too. So there we got the 8.88 on that one. And then I think it would be useful to, when you actually do this in practice, if you have the debt amount, you might do a calculation like this. You'd be saying, well, here's the debt, 100,000 on the debt again. And then my calculation, if I pull out the cost of debt after tax percent, colon, that would be the interest rate. The interest rate is going to be equal to the 12%. And then I would like to be able to go right to numbers group, percentify the calculation of 1 minus the rate, the tax rate. And then that's going to be equal to, we're going to say 1 minus the tax rate, which is this 26%. That will then give us, if I percentify that, font group, underline this, that's going to give us our cost of debt after tax percent. Pulling that out to the outside, the 12 times the 7.4, making that into a percent, adding a decimal or two. And note this calculation right here basically mirrors what we did up top here. And that would give us then our end result number. Let's indent this, alignment, indent here, indent this one, make this C a large C, otherwise known as a capital. And this is going to be the cost of debt after taxes, which would then be the 100,000 times the 8% in terms of a dollar amount. Let's go ahead and underline here. Let's do the double underline here, the W. Double D underline. Okay, so there we have that. Let's do it a couple more times here because that was good. That was fun. And so I want to do it again. So down here, same kind of concept, different numbers. So the company can issue debt interest rate 10%. Now we're going to assume the tax rate. We're probably thinking about the last tax rate, the marginal tax rate, making the decision on the margin at 32. So let's think about the cost of debt after tax percent. We're going to say, all right, let's do this again. Interest rate, and this is how you get good at this. You do this like a million times until you're like good at it. And then we got the 10%. Percentifying that numbers group, percentify it. Subtotal, which is going to be the 1 minus the tax rate, and shift 0 colon, and then this is going to be 1 tax rate is going to be equal to the 32% this time. Going to go to the numbers group, percentify, and then font and underline. There's a line underneath, and this is going to be a subtotal. Pulling this into the outside, we've got 100% minus the 32%, and making that a percentified numbers, that leaves us with the 68%. So we've got the 100% amount minus the 32, which means we have 68 amount, basically, that it's not going to be, we're not going to get back on basically a tax deduction kind of concept, right? So we had the 100% minus the tax rate, 68, and we're going to underline that, font group and underline. So then if we take the cost, which would have been the 10%, and multiply it times the 1 minus the tax rate, we're thinking the cost is actually the 6.80%, and this is the cost of debt after tax percent. And let's give a double underline here, so like so. Okay, and then we can do this calculation, same type of thing, go with our example down here. If I was to do this intuitively, I would probably start with a debt amount. In practice, we would probably know how much we want to borrow, or I might just use that. I'd say, okay, well, if I had the interest at the debt I'm going to try to get is like, debt is 100,000, and the rate of interest, if I'm not taking into taxes into account, is simply going to be the interest rate of the 10%. And that's straightforward if it wasn't for taxes messing everything up. So that would be numbers group, underline, font group, underline. The first one was a percent, not an underline. This would be the interest. And multiplying that out in the outer column. So that would mean that this would cost me 10% if it wasn't for taxes. So alignment, indent, going here, alignment, indent. Then I would probably think like, all right, well, what's the tax benefit then? Tax benefit. Let's do that. That would be like the tax deduction, which would be the interest expense deduction. So this is like that. This 10,000 rent on the money, the interest on the money, what we have to pay is bad, but for taxes it's good, because taxes weird. Tax is weird. And then why tax weird? That's going to be the 32% benefit, making that then a numbers, percentifying it. And this is going to be the tax benefit. And that's going to be equal to the 10,000 times the 32. Underline here, font group and underline. And let's go ahead and indent these guys, alignment and indent, and then indent again, alignment and then indent. Then we can think about this in terms of the cost of debt after taxes. In terms of dollar amount, is the 10,000 minus the tax benefit, which really only costs us 6,800 after we do the taxes. Then we can go, okay, well, what's the percent benefit then? So I could say, okay, well, what's the cost of debt after tax percent then? And that then is going to be the cost of debt after taxes is going to be that 6.8. We're going to compare that to the debt, dividing. That's when I say compare, divide. That's what we're doing. The 100,000, and this is going to give us the cost of debt after taxes, tax percent. Putting that in the outer column, that's going to be the 6.8 divided by the 100,000. Percentifying it, percentify, add a decimal or two. So there we go. Let's make this an indentation. Go into the alignment, indent. and line and indent this one again. Now, you want to do a quick calculation. Most likely in practice, it might look something like this. Instead of doing this whole thing, which I probably would do this whole thing just to double check it, but you could get there a little quicker. You're saying, okay, well, if the debt that I'm taking out is 100,000, and then I'm just going to go right to this end result of the 6.5. What's going to be the cost in terms of a dollar amount? Well, it's going to be the cost of debt after tax percent then. Let's see, get right to there, which is basically this calculation we did up top. A little bit simplified or a little bit condensed, let's say. We'll say the interest rate is going to be the 10%. That would be the cost if there were no taxes. But there are taxes. Taxes are a thing in the world. Death and taxes, they are things that are real, and we have to deal with them. So 1 minus the tax rate, and that's going to be equal to 1 minus the tax rate. And then we're going to go to the numbers group and percentify that. And then let's underline it, font group, and underline it. And that's going to be the cost of debt after tax percent. Pulling out to the outer column, we're taking the 10% times the amount basically after, not including the tax, right? The 100% minus the tax rate, or the 68% in this case. And that's going to give us then, if we go to the numbers group, percentify it, add a couple decimals, we're back to that 6.80 font group underline. Then we can multiply this out and say, well, if it's 100,000, the real cost isn't 10%, but that's 6.8, which means it's going to cost us 6,800. And let's go ahead and indent these here. Alignment, indent, and then indent again. And this is going to be, then I'm going to call this the cost of debt after taxes. Now, this is a pretty calculation that's going to be an easier one to do. Notice this one gives you a lot more information, actually. So in practice, if I'm really analyzing something, I might do the full thing here. So I can basically say, okay, that's the rent. You know, that's how much after the, you know, the rent, the benefit after, and then the percentage amount. This is actually could give you useful more information. But when you're doing comparison between two kind of competing types of financing, you might just want basically the cost in terms of a percent. And if you're given an example or you want a quicker calculation, you should be able to get to it in this format as well, which of course would be also be easier to do if you're doing like a test question. Your time is a constraint. Okay, let's do this one more time. This is the last time that we have to do this, and then we're gonna have to stop. So you want to make sure you're picking up the full enjoyment of it this time, because it's the last one. So we got the interest rate is going to be 8% this time. Tax rate now is at the 40%. So let's calculate it with our cost of debt after tax with, let's just do the percent. We don't even need the actual debt in this one. So we're going to say this is going to be the interest again. Interest, I'm going to put this in the outside. That would be the cost if there was no tax effect. That's like the rent on the purchasing power of the money that we're using to finance the organization. But then we're going to take that times the 1 minus the tax rate. 1 minus the tax rate. I'm going to put that in a subtotal, indicating that with a colon. And then we're going to say 1 and then the tax rate, which is going to be equal to the 40%. So 1 is obviously 100% minus the 40% here. You can make that a percent this time if that would be useful. Let's make that a percent. Let's underline here. Font group underline. And then this is going to be, then I'll just call it the subtotal, because it's the total underneath, subtotal. So this is going to be the 100% minus the 40%. So again, you can think about this a couple different ways just to make it sense in your mind. You might think of it like 100% of the debt, for example, minus the 40% of the debt means that the 40% representing, in this case, what you're kind of actually going to get back in terms of taxes. You're going to have to pay the full 100%. You're going to kind of get 40% back with regards to a tax benefit. If we make the numbers group and percentify that, that means we're left with a 60%, the 60% debt, which we're not going to basically kind of get paid back in terms of a tax benefit. So if we take that 60% times the rate, then the cost that we have in total, 60% times the rate, is going to be then the numbers group percentifying 5%, adding a couple decimals. We're looking 4.80. Let's 4.80. Let's underline here. Go into the font group and underline. So there we have that. Let's do some alignment, aligning out this one and put the subtotal out there. And then we're just going to call this the cost of debt after tax. And I'm going to say percent here. Percent. So like so. Okay, then let's do our examples down below. This would be the long example, which I think would be the most intuitive and might give you more information in practice, where we would actually assign a debt amount. And in practice, you might actually have a debt amount where you could basically do the calculation with a debt number, which can be more intuitive and give you a little bit more detail about what might be going on. So let's calculate the interest then. If I know what the debt is, then I'm going to say, all right, if it's debt's going to be the 100,000, and I'm going to say, whoop, that's not the, hold on a second. We're going to say the debt is going to be equal to the 100,000, and then the interest rate, going to pick up the interest rate. If I can finance it for the 8%, then I'm just going to pick up that 8%. Let's percentify that. Numbers group, percentify. Font group, underline. And then this will be called the interest. Putting that on the outside, the 100,000 times the 8%. That would give us the 8,000 of the cost. Then I'm going to go ahead and indent here. Go into the alignment, indent, interest, and indent that again. Then we could think, okay, what's the tax benefit? Tax benefit on this. And I could say, well, that's going to be the interest expense, or deduction, which is going to be that 8,000, which is now good because it's for taxes now. So bad things are good, good things are bad, taxes. And we're going to say tax is the 40%. And so now we're going to say numbers, underline, font group, percent, and then underline. And then we're going to say this is going to be the tax benefit. And that'll be equal to the 8,000 times the 40%. So 3,200 on the tax benefit. Let's go ahead and indent here, alignment, indent, and then indent this one again. And then I'm going to say, all right, well then what's going to be, that's going to give us the cost of debt after taxes on a dollar amount basis, which would simply be the 8,000 minus the 3,002. So it's not going to cost us 8,000 as it would if it wasn't for taxes. We're thinking we're going to get 3,002 of it back in the form of basically taxes or tax deductions or reductions. And then we're going to say then, well, what's the cost as a percent? Cost of debt after tax percent. This is useful because it's useful to compare to other kind of things as a percent oftentimes. So I'm going to say, all right, well then we're going to say, let's pick up the cost of debt after taxes, which is the 4,008, and compare that to the debt, meaning divide. That's what compare was going to mean typically. And that's going to give us then the cost of debt after tax percent, I'm going to call it. And let's go ahead and indent here. We're going to go to the alignment, indent, indent again. This is going to be then the 4,800 divided by the 100,000, making that a percent, numbers group, percentify, adding some decimals to, and then I'll underline it here, font group, underline. I'm going to double underline there, double D, underline. There we have it again. Let's do it this way. Now, this is probably the shorthand way if you actually had the debt, which will kind of implement this calculation in it. We'd say, all right, well, if we had the debt then, and we knew that was like 100,000, I could shorten up this calculation by basically just getting right to the cost of debt after tax percent here, which would be the interest rate. That interest rate times, times 1, I'll make it 1 minus the tax rate. And so we got the interest rate, which is going to be then equal to the 8%. And we'll percentify that, numbers group and percentify. Then this is going to be equal to 1 minus the tax rate. And we're then going to go to the numbers group, percentify. We're basically doing this calculation up top now. Font group, and then underline in here. And that's going to give us the cost of debt after tax percent And there we have that, pulling out to the outside, the 8% times the 60%, percentifying that, going to the numbers group, percentify, and then adding some decimals. So we're at the 8.4, and then let's indent this one, go into the alignment, indent, and then indent. And now this calculation right here is basically a shorthand of this. And if we actually have the debt, then we can calculate that against the debt, which would be the 100,000 times that 4.8, getting us to that 4,000 that matches this number that we did in this format. And this is going to be what we'll call the cost of debt after taxes. And let's go ahead and underline here. Font group, underline, and there we have it.